Here's where the numbers come into play. Think of a company's financial reports like its report card. It shows you how well it's performing and where it might need improvement. The main financial statements you'll focus on are the income statement, balance sheet, and cash flow statement. This tells you how much money the company makes, revenue, and how much it spends, expenses, leaving you with the net profit. You can calculate metrics like the profit margin, which shows you how efficiently the company turns revenue into actual profit. Example, if a company has a profit margin of 20%, it keeps 20 cents of every dollar it earns. Compare this to competitors. Is it higher? That shows strong operational efficiency. Now that you've identified a strong industry, it's time to understand how the company you're evaluating fits into that world. Ask yourself, what does the company actually do? How does it make money? Does it have a competitive advantage? Take one of the world's streaming giants, like Netflix, for instance. Netflix's advantage isn't just its enormous library of content, it's also its ability to invest in original programming and leverage its data analytics to predict what viewers want to watch. That's their competitive edge, something that sets them apart from the competition, like Disney Plus or Hulu. If the company doesn't have a unique selling point, it may struggle to stand out in the market. Look for what's known as a moat, a term popularized by Warren Buffett. A moat is anything that protects the company's market share, whether it's a loyal customer base, patented technology, or significant cost advantages. Before diving into a specific company, it's important to zoom out and look at the industry it operates in. Think about it. Would you open a lemonade stand in the middle of winter when demand is low? Probably not. Industries operate the same way. Some thrive in certain environments, while others struggle. Start by asking, is the industry growing? What trends or technological advances could shape its future? Are there challenges or disruptions on the horizon, such as regulatory changes or supply chain issues? For example, if you're looking at a tech company, research trends like artificial intelligence or renewable technologies that could affect its future. A growing industry often means more opportunities for the companies within it. Some stock market gurus also refer to it as the sunrise industries. If you have made it so far, make sure you subscribe and like the video. Hey everyone, welcome back to Growth Engine. Today, we're diving into the fascinating world of fundamental analysis, an essential tool for any investor looking to assess the value of a company. Whether you're a newbie or looking to sharpen your skills, this video will give you the essential insights you need. Imagine this. You're scrolling through the stock market, intrigued by companies with skyrocketing prices or enticing dividend yields. But then the questions hit you. How do I know if this is the right investment for me? Or, how can I tell whether this company is truly valuable, or if I'm just chasing a shiny object? Well, the answer lies in a skill that every serious investor should master: fundamental analysis. Don't worry, this isn't something that only financial wizards can do. Whether you're a seasoned trader or someone just starting out, fundamental analysis is your ticket to understanding what you're really buying when you invest in a stock. Today, we're going to break it all down, step by step, so you can approach investing with knowledge and confidence. Before diving into a specific company, it's important to zoom out and look at the industry it operates in. Here's where the numbers come into play. Think of a company's financial reports like its report card. It shows you how well it's performing and where it might need improvement. The main financial statements you'll focus on are the income statement, balance sheet, and cash flow statement. This tells you how much money the company makes and how much it spends, leaving you with the net profit. You can calculate metrics like the profit margin, which shows you how efficiently the company turns revenue into actual profit. Example, if a company has a profit margin of 20%, it keeps 20 cents of every dollar it earns. Compare this to competitors. Is it higher? That shows strong operational efficiency. This is a snapshot of what the company owns, known as assets, and what it owes, known as liabilities, as well as its net worth, referred to as shareholders' equity. Pay attention to debt levels, as overly leveraged companies can struggle when facing economic downturns. A helpful ratio here is debt to equity. Generally, the lower this ratio, the better. Understanding the balance sheet helps you evaluate a company's financial health and its ability to withstand economic challenges. A profitable company isn't worth much if it doesn't have cash coming in. Cash flow analysis tells you whether the company generates enough cash to fund its operations, pay dividends, or invest in growth. Keep an eye on free cash flow, the money left after operational expenses and capital expenditures. Companies with positive free cash flow are often in a better position to invest in innovation or weather tough times. Worried about all these numbers spinning your head? Don't be. That's where financial ratios come in. They simplify the data and help you compare companies. Here are 3 crucial ones to focus on. Price to earnings ratio, PE. This tells you how much investors are willing to pay for each dollar of a company's earnings. A high PE could mean the stock is overvalued, while a low PE might indicate a bargain or trouble. Example, if stock A has a PE ratio of 30 and stock B has a PE ratio of 15, stock A might be seen as more expensive relative to its earnings, used to compare a stock's market value to its book value. A PB under 1 could mean the company is undervalued, though it might also signal a declining business.
Effectively, management is using shareholders' money to generate profit. The higher, the better, as long as it's sustainable.
These ratios are just the beginning. With practice, you'll learn to combine these metrics for a clearer picture of a company's health. Even the best business models can fail if the people running the company are inept or dishonest. That's why it's critical to evaluate the company's management team. Research the CEO and other executives. What's their track record like? Have they successfully grown the company or turned around failing businesses in the past? Do they own company shares? This is often a sign of confidence in their own leadership. For publicly traded companies, annual shareholder meetings or earnings calls can provide insight into how transparent and forward-thinking the leadership is. Finally, ask, is the stock worth the price I'm paying? A great company isn't always a great investment if the stock is overpriced. Compare the company's valuation metrics, like PE or PB, to its peers and the industry average. Also, think about growth potential. Are they expanding into new markets? Are they investing in innovation or infrastructure that could drive future revenue? For example, a company investing heavily in green energy today might see exponential growth in the next decade as the world transitions to sustainability. Fundamental analysis is a powerful tool. It's like being a detective, piecing together clues to understand a company's story. Start by analyzing the industry, examine how the business operates, dig into the financials, and evaluate the management team. And here's the best part. Every time you do this, you're learning. You're sharpening your skills and building an investor's mindset. So the next time you're tempted by a hot stock tip or a social media buzz, take a step back. Use the tools of fundamental analysis to cut through the noise and decide for yourself. After all, investing isn't a game of luck. It's a strategy of understanding. Happy analyzing, and may your financial journey be as rewarding as the time you've taken to truly know your investments. If you have made it so far, make sure you subscribe and like the video.